job is to keep time. The session is strengthening states' finances in India. How we really define that strengthening, whether it relates to the debt to GDP ratio, deficits, quality of expenditures, using the necessary powers to raise revenues, various ways to define what it means to strengthen the state's finances. But that is, I think, going to be the prerogative of the various presenters. The way the session is organized is Poonam will do a presentation taking about 25 minutes. Originally, we had another speaker. And since TV Somnathan is not here, we are able to use some extra time from that. So the original allocation was 22 minutes for Poonam, then 12 minutes for each commentator or speaker. What we might do is Poonam can take 25 minutes, and each of the speakers can take 15 minutes or thereabouts, and then we'll open it up. Let me just say, so that you understand, since I currently chair the 16th Finance Commission, there might be some expectation I'll say something, but I'm afraid, we are still at a stage at which we are largely there to listen to various constituencies. We started our consultation with the states, have done one visit to Himachal Pradesh, and next is next week to Chhattisgarh. But that's where we stand largely. So at this point, we are very much at a stage at which we are listening to all constituencies. So any suggestions you have are very welcome.
Thank you very much, Professor Panagariya, for being here. Let me take this opportunity to publicly congratulate you for being the chair of the 16th Finance Commission. And it's a real privilege for us that you could find the time to be here today. We know how busy you must be with your mandate. So the work that I'm going to be presenting today is based on some research we have been doing at NCER. We started this area of work about a year and a half ago. As you know, and others have claimed before me, I'm a macroeconomist as well by training and practice. And fiscal is not something that macroeconomists necessarily do. They are called public finance economists. But fiscal is a very important issue for India, given its debt to GDP ratio. So with Barry Egan Green, a group of young aspiring, young research assistants aspiring to be economists, we started dabbling into public finances. So for those of you who were here in the last India Policy Forum, Barry and I had presented a paper, India's Public Debt, where we looked at India's general government public debt. The title of the paper was Debt Dilemma. And we are extending that work to look into the finances of the states. And, the work got started just after the last IPF a year ago. And my research assistants and I, kept pretending to be making progress, but it was very, very hard. When you have many diverse states, how do you divide them up? How do you analyze them all at once? Just not easy. But finally, in the last 2 months, we had a little bit of a breakthrough when we decided how we can look at the states. And today's presentation is based on all of these efforts. Praveen, my time should start now. That was the introduction. So I get my full 25 minutes now. No, they don't have to congratulate you and so on. So, first, a few facts about state finances, how my presentation is organized. This work is joint with Barry Egan Green and 3 of our very bright young colleagues. So first, a few facts about state finances. How indebted are the Indian states? We keep reading in the press, there is fiscal stress. There are some states who are doing things not as well when it comes to tax collection or spending priorities. But taken as a whole, taken collectively, how indebted are the Indian states? Do they matter for the debt sustainability of the country? Is state finances collectively a macroeconomic sustainability issue? And then after quickly addressing these two questions, I quickly go to the heterogeneity across states. How does the debt level or debt evolution differ across states? When I say debt evolution, we are focusing on the last 10 years. Again, it was a part of our exercise, should we look at a longer period or a shorter period and settle for 10 years. And what is our assessment of certain states being already in a debt distress situation or a debt trap situation? Will the situation amend itself? So we do projections, state by state, debt projections of debt to GDP ratios, and we ask ourselves how are they going to evolve in the next 5 years? How well do the current institutional arrangements work to incentivize the states to be fiscally prudent? And then I will follow with a few questions for the panelists who have been working on these issues or have first-hand experience of these issues longer than or better than I have. So how indebted are the Indian states? So you may recall from the last India Policy Forum, for those who were here, India's public debt is very, very high. For its income group, for many other indicators, it increased to about 90% of its GDP during the pandemic, and now it's slowly normalizing. But even so, it's 82.5% of its GDP. States hold about 1/3 of it. 2/3 is held by the center, 1/3 is held by the states. There has been some variation over time, but not a very large one. State share has varied between 30 to 40% in early to mid-2000s until the states went on to their fiscal rules. It went up to about 40%, and now it hovers at around 1/3, 30 to 33%. This is how their debt levels compare. 1/3 is the states, as I said, 2/3 is the center. So 54 or 55% of GDP is held by the center, about 28% is held by the states. So when we started looking into these questions, do they matter for the overall debt of the economy or its sustainability? One way that we figured out would be to look at the past episodes when public debt in India, the general government public debt in India, increased by a very large amount. And what was the proportion contributed by the center versus the state? So we identified 3 such episodes. The last one is familiar during COVID, but even prior to that, there was an episode from mid-90s to early 2000s. In 2014-15 to 2019-20, as you can see, the red one is the contribution of the states to the total increase in public debt. It's not small. It is significant. So a small message is both the center and the states have contributed to the episodes when there have been very large increases in public debt in India. Do they collectively matter for the debt sustainability of the country? You may recall that in the 2023 paper, we had concluded that despite the debt levels being very high, India does not face a debt sustainability issue. And it was for 2 reasons. When we do our debt evolution projections, it's not on an explosive path, primarily because of very high nominal and real GDP growth rates, nor does it have a rollover risk. The rollover risk has to do with the composition of debt. Most of the debt is held domestically by domestic institutions, it's long-term, it's denominated in rupee. Those institutions themselves are held by the government, so nobody is going to dump this debt out in any case. So we had concluded that despite being very high, India does not face a sustainability risk, and that was the dilemma, right? And there can be other risks, that it's spending a whole lot of money in servicing the debt rather than spending on education and health, but sustainability defined as being on an explosive debt path or a rollover risk, those risks do not exist. Now, when you look at the states collectively, you reach the same conclusion. primarily because states also have a similar composition. If anything, there are more restrictions on states to hold certain kind of debt. In addition, states have an implicit guarantee of the center, which means, if anything, states' debt is safer than that of the center or of the general government. So when I say they have stricter restrictions, states cannot hold any debt in foreign currency, and they cannot hold any debt on floating rates. And as I said, in addition, there is an implicit guarantee. And all of this gets reflected in the states paying hardly any premium on its debt, or the more indebted states paying hardly any premium on their debt. And I'll show a little bit of evidence that, if anything, more indebted states at times have it better, which is interesting. So just to put some data in front of you, as I said, red bar is the short-term debt. State short-term debt is even less than that of the center, which in any case is very low at around 8 to 9%. Ownership of both the center and the state's debt is institutional, diverse, and it's becoming more diverse. It's not that they are overly dependent on public sector banks to finance their debt. Now they're insurance companies, they're provident funds, who are holding their debt. As these components are increasing, insurance companies and provident funds, they have to hold, it's the mandate to hold statutorily, they have to hold a large percentage of their balance sheet in government debt, and that can be state or the center. So now we go to how does the debt level or its evolution differ across the states, and what can we say about specific states doing worse than the average. So here we have data at 2 points in time. Public debt in 2012 to 13 was already quite large for some of the states. You have the states like West Bengal, for whom the debt to GDP ratio was 40%, and then you had Telangana and Chhattisgarh at very, very low debt to GDP ratio. In fact, the average during 2012-13 was only 23.5%, and then, of course, there are states above and below the average. The average increase during the last decade has been about 7 percentage points, but not concentrated, but not distributed evenly across states. There are some states which have accumulated a lot more debt during the last 10 years, and then there are states which continue to remain prudent. And this is how the numbers look. So there are states such as Punjab, for whom the debt to GDP ratio has increased by 16 percentage points. On the other extreme is Gujarat, whose debt to GDP ratio has declined further from an already low level. So we really have three kinds of states. I said there was a challenge, how do we analyze the states? So in one part of our research, we are looking at three kinds of states. There are 11 states out of the 21 we analyze, for whom the average increase in debt to GDP ratio exceeded 10%. There are about 5 states where it was close to 0 or negative. Those are on the right-hand side of this chart. And then in the middle, there are about 5 states for whom the increase was about 6 percentage points. So a huge amount of diversity across states. Now the question is, what are the correlates of this diversity? In a simple analysis where we are asking whether the correlates of debt evolution differ across states, and if so, what are the most significant correlates? 2 things stand out: primary deficit and contingent liabilities. Primary deficit is easy to understand, and it is numerically quite significant, which again is a no-brainer over a 10-year period. A 1 percentage point increase in average primary deficit is correlated with 7.5 percentage point increase in debt. It's almost, linearly, it can be interpolated. But what is surprising is the contingent liabilities and how the states differ on those. And so which means contingent liabilities do not remain contingent liabilities, they all materialize. The coefficient is 1, right? What we do not find is that average growth rate. You may say that some of the states have been growing slowly, and that's why, what can they do? They are highly constrained. They don't grow much, and their debt to GDP ratios have increased. But we do not find any correlation in average real GDP growth rate and how the debt has evolved in the last 10 years. we find a very, very weak correlation in growth rate and interest rate differential either. So those two factors, and we looked at the data, there were only 21 states, so you can really look at the data carefully and figure out that this is the case. Now, the question is, how will things go from here? Will the situation amend itself? What is the projected level of debt during next 5 years? So our conclusion is that the states are unlikely to be able to mend, at least the most indebted states are unlikely to be able to mend the situation themselves. And it's for two reasons. First, that they already spend a large proportion of their revenues in meeting their committed expenditure. And I'll show some numbers on that, which includes wages, salaries, pensions, and interest payments. I have not included subsidies here. The moment you include subsidies, there are many states which are spending more than all of their revenue deficit on just these four items. 110% of their revenue expenditure or receipts is on these, which means that they cannot grow out of this situation, right? If they do not have much more to spend on productive capability enhancing capex, they cannot come out of it through higher growth. We also find that under the business as usual scenarios, their debt projections mean that, of course, if they are doing things as they have done in the last 10 years, their debt levels will increase further. Debt levels of the states which are already highly indebted. So first on how does, I mentioned primary deficit is a very, very strong correlate of how the states have done in the last 10 years. Here we are trying to unbundle the primary deficit, and we asked, how do their revenues differ? Is it a problem of revenue? Is it a problem of total expenditure? Is it a problem of capex versus revenue expenditure? Or is it a problem of different heads under revenue expenditure? So interestingly, we did not find that the more indebted states or the states which have accumulated more debt, that they have a different tax revenue or non-tax revenue. So their revenues are very, very similar. The expenditures are very, very similar. The revenue expenditure and capex expenditures are very, very similar. What differs is the composition of their revenue expenditure. And this is where we start seeing variation, which comes out as significant. So the expenditure on wages and salaries, there is quite a large dispersion. It's as a percentage of state-specific GDP. Goes from 6% in Gujarat to 16% in Chhattisgarh, and Punjab is at 13%. If you, so this is average expenditure on wages, salaries, pensions, subsidies, and interest payments as percentage of GDP. When you calculate the same variable as percentage of total revenues, and this is what I meant, again, the variation is very, very large. Odisha is a state which gets a lot of mining revenue, so its revenue is very high. But then there are other states as well which spend less than 50% of their revenue receipts on these four items. And then there are states such as Punjab and Tamil Nadu and Haryana, which are basically spending all of their revenue receipts on this, which means at times they have to borrow to spend on these things, and all of their capex has to be through borrowed funds. So here are just, coming to some numerical numbers. So we have average expenditure on wages and salaries separately, pensions, subsidies, interest payments, and column 5 is when we add them all up. And we have a dummy for above median and below median increase in debt across states. So what we see is that when you go to subsidy, when you come to pensions, there is a small magnitude there, which is not significantly different from zero. When you come to subsidies, there is a larger amount. Borderline significant. When you come to interest payments, of course, there is significance. When you add them all up, the difference is quite large. An average, a state which is below the median spends 9.5% of its GDP on these four items, and a state which has had more increase in debt spends 1.6 percentage point more, and that's significant. A similar exercise has been done where the variables we are looking at are calculated as percentage of their total revenue receipts. And here, if we just focus on the last column, a below median state spends 65% of its revenue receipts on these four items, And a state above median spends 11 percentage point more on these 4 items. So, if nothing else changes, if the states have similar levels of primary deficit, growth, and real interest rates that have prevailed in the past, what would happen in the next 5 years? One can choose 5 years, 7 years, 10 years window. We chose a 5-year window, primarily because we want the Finance Commission to be able to relate to these numbers. So in a business as usual scenario, average debt to GDP ratio of the states will increase. Some states will experience much more increase than the other states, and I'm just looking for the average increase here. Let me just see, I have it in my notes somewhere, unless Aisha remembers it and tells me that number. I think it was about 4.5 percentage point average increase of the states. 3.5%, not 4.5%, yeah. But of course, there is a great deal of heterogeneity. Uttar Pradesh, Odisha, Gujarat, West Bengal. West Bengal, surprisingly, they have a very high debt to GDP ratio, but it has not increased much at all in the last 10 years. And it's unlikely to increase going forward, and primarily because of compressed capex. But then there are other states which will accumulate much more than the average. So what would the numbers look like actually in 5 years from now? So we have 2 scenarios. A baseline scenario where we assume no contingent liabilities are absorbed, which is not a reasonable scenario because we do see that debt to GDP ratios and changes have been correlated significantly with contingent liabilities. So on my left-hand side is the panel projected debt to GDP ratio on the baseline scenario where we are assuming no contingent liabilities have been absorbed. And there are a handful of states which will have debt to GDP ratios exceed 50%. I know Professor Panagariya's first state visit was to Himachal Pradesh, so here's the number for Himachal. And Punjab, we have guests here from Punjab government and academics, so it will increase 51% because Punjab is a state with high contingent liabilities. In scenario 2, its debt to GDP ratio can increase to 55% in the next 5 years. So how well do the current institutional mechanisms work to incentivize fiscal discipline? It was the most interesting part of the paper. So what is the institutional setup in the country? RBI is the debt manager. Ministry of Finance is there as a monitor as well as the one who releases funding. There is CAG. There is Finance Commission. I don't think NITI plays an active role, but I might be wrong. So when you correlate the interest rate at which the states are raising their debt, states at different level of indebtedness, you get a flat line. Everybody gets a similar interest rate, no matter how indebted you have been or what you have done. So this is, again, a simple correlation of debt to GDP ratios in 2021-22. You can do it at 10-year averages. You can do it for a different year. You get the same flat line. We saw the spread in many different variables, whether it's contingent liabilities, whether it's primary deficit, whether it's debt level. When you plot the interest rates, there is no variation. There is no spread there. And one can play with the data in different ways, and that's what. Interestingly, what is the maturity? So this is where the RBI plays a very constructive role in a way. More indebted states are able to raise longer term debt and they don't pay any term premium, right? So the maturity, average maturity, look at Punjab. Punjab, I think, has raised 40-year debts at some 7.5%, if I'm not wrong, right? So this is the most telling slide. Aisha, thanks for preparing it. We're comparing Punjab and Gujarat's terms of borrowing in the market. 2 states at very different ends of the distribution of debt and how it has changed. Raised significantly large amounts in the market. Punjab does not pay any premium for raising its debt and has been raising its debt, which is twice the maturity as that of Gujarat. So I think I need not get overly excited about this phenomenon. I've made the point, so I can go forward. Another thing we have done as a part of this project, and Shubhashri, thanks for that, it was a lot of hard work. We have looked at then the fiscal rules. I said institutions. So there are fiscal rules for the states. There are three kinds of fiscal rules for the states: revenue deficit target, fiscal deficit target, and a target for total liabilities. And this is the average of 21 states over the last 10 years. And there is some amount of compliance. But more interesting than that is the compliance across states. So compliance varies across states. There are serial offenders, or whatever you call them. West Bengal and Kerala, for revenue deficit rule, 0% compliance. Punjab's compliance is 10%. So out of those 10 years, they met the target 1 year. But there is no implication for that. So one can do the same thing for fiscal deficit rule, one can do the same thing for total liabilities, or one can look at the average compliance of all the three rules, right? So again, you see a great deal of variation. States which are doing well, Gujarat and Orissa, they have nearly 100% compliance. And then Kerala's, West Bengal's, Punjab's have very weak compliance. And of course, looking at that, it's a no-brainer that when we do a simple correlation of average public debt and average compliance, we'll get a negatively correlated relationship, and that is what we get. More indebted states have weaker compliance. The same thing in regressions, etc. So we need not necessarily spend more time on it. Now, here are the questions for the panel. So what should we do about it? It's not a macro risk. At this point, it's not a macro risk for the general government, it's not a macro risk for the states collectively. But should we still be concerned about this situation, about the heterogeneity, about the fact that some of the states will accumulate more debt? Do we call it explosive? Perhaps not. But if nothing is done, the pattern will continue. Can we conclude that some of the states have reached in a situation where they need a bargain? Can they ask for debt relief from the center in lieu of some promises, better tax collection, privatization, better quality of spending, maybe wider reforms? But then the 50-year interest-free capex loan from the center, is that the bargain? And if so, what is the pickup on that? What is the take-up on that? We haven't researched that. Should fiscal rules and institutions be strengthened to have more bite? What is the use of fiscal rules if they are not adhered to? And it's not specific to the states, it's the center as well, right? We don't know what is the status of fiscal rules for the center either. What should be the role of the RBI as a debt manager? It's more about let's keep everybody in a joint family happy. Let's look after the weak one, right? That's the phenomenon we have. Should they allow more market discrimination across states? And if you do that, will that result in some market reaction? Will it mean that the implicit guarantee that the market has come to trust is being eroded? And will that result in some reaction which is less than ideal? But another important question is we're always looking at it from the point of view of the more indebted states. What about the more prudent states? Shouldn't they be getting a better deal? Shouldn't Gujarat be paying a much lower interest rate? Shouldn't they be asking, why should I subsidize the more indebted states? And should Professor Panagariya, you don't have to answer this, should the Finance Commission reward the states for their fiscal prudence and incentivize the profligate ones to become fiscally more responsible? Thank you.
To my left is Dr. Govind Rao. Govind, of course, is a well-known public finance economist. He and I have collaborated on several projects, written a couple of books together. And, of course, he was a very critical member of the 14th Finance Commission. Many other things I could say about him, but that is... he also headed the National Institute of Public Finance and Policy, NIPFP. And before that, the ISAC in Bangalore, so very prolific writer. We all go to him for public finance questions. Let's go to Dr. Govind Rao. Govind.
Thank you, Dr. Panagariya. Let me at the outset thank Poonam Gupta for asking me to speak on a subject on which I have been working for long. And I have I don't know where to start and where to end, and that's the problem. The interesting part is when Poonam met me in 2010, she said she would not go, she doesn't know much of a public finance and she was only going to work on macro. But then now I see, after joining NCAER, she is starting working on public finance as well. Of course, from the macroeconomic perspective. It's a good thing, and well, public finance will be much richer by your intervention. It's important to understand the whole issue of state finances in this country, because it accounts for almost 58 to 60% of the spending and raises only about 1/3 of the revenues. And in fiscal federalism literature, the first generation theory, as they call it, as well as Oates taught me, macroeconomic stabilization is predominantly a central function. And Poonam has focused on macroeconomic stabilization issues related to the states. And both macroeconomic stabilization and redistribution are predominantly central functions. That does not mean that they do not have implications for the macroeconomic. State finances do not have implications for macroeconomic stabilization, but the way it has to be pursued by the center. That's one of the reasons why even in the Constitution, if you see, Article 293, subclause 3, which basically tells you that the union government has to control the borrowings of the states if it is indebted to the center. You know, Article 293 is very clear that the overall control on the debt is the responsibility of the union government. So, I mean, that must be taken note of. And, if so long as the states are indebted to the union government, they have to seek the permission of the center to borrow. And the union government can put conditions on the borrowing conditions, on the borrowings there as well, apart from placing the limits on borrowing. Now, states have an important role in allocation decisions. In a Musgravian classification, if you have allocation, distribution, stabilization. Allocation, in this country, states have a predominant responsibility for human development and co-equal responsibility as far as economic services are concerned, economic infrastructure services are concerned. So, Dr. Poonam Gupta has mainly touched upon the stabilization issue, the whole issue of debt sustainability and issues relating to that. I will not by and large go into those issues, except agreeing with her, except that on one issue, that she mentioned that Gujarat was the best as far as compared the debt levels are concerned. It's not Gujarat, it is Orissa, which has the lowest level of debt. Just check your own numbers, you'll see.
Numbers are there.
Improvement has been Gujarat. Improvement has been Gujarat, but the debt levels are lowest in Orissa. But anyway, that's a matter of semantics. Let me make some 5 points with regard to this issue. Broadly, in my view, the states have calibrated the rule-based policy in a much better manner than the union government. States and in aggregate. If you see, except until the year you had the pandemic, by and large, their revenue deficits were almost zero, and the fiscal deficit was around 2.5 to 2.8% in the aggregate. Now, by and large, they have followed that particular thing. And more recent period has seen some disturbing trends. And the revenue deficit in 2022-23 is estimated 2.6% of GDP. but then the point is, I mean, they assume that they can go on borrowing and then put that, but by the time the account numbers come, you will see that, it will be much lower than that. But nevertheless, there has been some violation after. I mean, I'm not saying that it's all because of the states. There have been some interesting developments. In fact, Dr. Gupta talked about the decline in the states, indebtedness from 40% to 30% from 2004 to now. The reason is very clear. It was the 12th Finance Commission which gave an incentive to the states. I mean, it said that they should follow the rule-based fiscal policy, pass the Fiscal Responsibility and Budget Management Act, and the state, passing that act would get 50% remission on the outstanding loans of the center. And every improvement in the revenue deficit was to be correspondingly reduced, debt was to be reduced. So, states indebted to the center substantially declined after the 12th Finance Commission made the recommendation, because all the states except two passed the Fiscal Responsibility Act, West Bengal and Sikkim, and West Bengal was given the same offer by the 13th Commission. West Bengal followed that, and then, in fact, significant part of their indebtedness in fact, the 50% of the indebtedness of the states were actually, the indebtedness of the state from the center were actually written off. Now, the problem with this thing is not actually the transparent debt that you see in the budget. It is the contingent liability that is the bigger problem. Off-budget liabilities, and predominantly the power sector. You had several reforms on the power sector. You have the Accelerated Power Reform Development Program, you have revised Accelerated Program, and finally the latest, the Uday. But then, I mean, if you see as of 22-23, total losses amounted to 1,06,069 crores of the discounts, and in addition to that, actual subsidy given by the states amounted to 37,000 crores. So you have almost 1,40,000 crores of debt, which is of losses of the public this thing, and in addition to that, you have losses in the transport sector and others. Under recovery in irrigation, under recovery in transport, there are a number of other problems there. Now, in fact, a classic example of off-budget liability is the Kerala's Infrastructure Investment Fund, which was floated, called as a masala bond in London Stock Exchange. It's a class action. The question is, this was done. I mean, obviously the states can't borrow without the permission of the union government, but then they have gone and then created a company and then borrowed a separate government company and borrowed through this particular thing. So the crucial thing that is required is the hardening budget constraint of the state. Unless and until you do the hardening of the budget constraint, there will be problems. The third that I want to make is, there is the low income states have a larger proportion of children in the age group of 0 to 14. They are the ones who require a much more spending on education and health care. Although in the aggregate states, the fiscal position is satisfactory, as I said, some of the individuals, I'll come to that later, some of the individual states have very serious stresses, as was pointed out by Poonam. I think that includes Punjab, Kerala, Bihar, Rajasthan, and even now even Andhra Pradesh has joined the thing. And even one of the fiscally prudent states like Tamil Nadu, Tamil Nadu is slipping up, in the process. Consequently, the share of revenue deficit in fiscal deficit is high. Punjab, it is almost 71%. We talked about already the committed liabilities taking over much of the revenues. I will not go into that. In fact, even the 13th Finance Commission flagged this. And it said there are 3 fiscally stressed states, which are West Bengal, Punjab, and Kerala. And said, gave it a longer period. And there is and in fact, a different adjustment plan. They didn't follow that. In fact, once you look at the 13th Finance Commission report for that. One of the important things that I want to talk about is there are significant interstate inequalities in spending on development expenditure. Lopsided priorities, very low spending on education. Center plus states is 2.6% of GDP. Very low spending on healthcare, which is 0.2% of GDP. In fact, the education experts say that you should spend 6% of GDP on education. The result is in many of the states, at the higher education level, teachers are not appointed. They are actually asked, the contract teachers are called from the colleges and then, there are, and in fact, the quality of higher education has been declining. And this is so in Orissa, this is so in Karnataka, this is so in many other states, where at the university level, you have 1 or 2 permanent teachers, otherwise it's all contracted teachers who come and teach. Now, if you look at the actual expenditures, it was the lowest in Bihar. And let me just to show you, you will see that in terms of the per capita income, if you see, and the per capita expenditure on education and health, education and social and economic services, if you see the huge, everything increases, but then even the best state has a low per capita income expenditure. Haryana, for example, the education expenditure is just about 3,110, health expenditure, and Kerala it is 2,000, less than 3,000. So, if we take total expenditure on social economic services too, the story is not very different. Now, the recent trends are very disturbing. There are too many poorly designed and targeted centrally sponsored schemes. In fact, they had 247 of them. That was reduced to 176. The previous UPA government made it to 66 umbrella schemes. Now you have 28 umbrella schemes. Not one of the scheme is this thing. See, generally in theory, we say general purpose transfers are there to enable the state to provide comparable levels of services at comparable effort. Specific purpose transfers are to ensure a minimum standard service. You can't ensure minimum standard service in respect for 28 umbrella services. You can take some 3 or 4, like education and healthcare, and then basically do that. Now, but unfortunately that is not the case. There has been proliferation, and accordingly you have the surcharges and cessors going up. Redistribution is the legitimate government activity. But then one should realize that, because the markets don't redistribute, one should realize that there is an opportunity cost. You need to weigh the opportunity cost, and you need to also, even if you are redistributing, better do it through cash transfers than through subsidies. Now let me just make, one of the emerging risks is that you see many of the states, there is something called Salmon mechanism in competitive federalism literature, which basically says that the best performing state things are imitated by other states. In this case, the worst performing cases are imitated by other states, and there is a proliferation of subsidies for electoral gains. Now, as far as the Finance Commission issue is concerned, I just want to take 1 minute. There is a traditional criticism of the Finance Commission, and that applies to the one which I was there as well. There are 2 problems with the Finance Commission reports. One is there is a tyranny of the Bezier, and the second thing is it does the job of a fiscal dentistry. Tyranny of the Bezier, because if your Bezier expenditures are low, you are making projections from there, and then obviously whatever you try to do, the expenditure at a low level stage will continue to be low. And dentistry, because the states which have been profligating and have large amount of debt accumulated will continue, their interest payments will be high. In Punjab, for example, 50% of the revenue goes for the interest payments. And, you estimate that you take, oh, this is a legitimate expenditure because it's an interest payment. You can't apply norms there. And then what happens? Then what happens is that they all end up with a much larger, even after the devolution, much larger gaps in the revenue account. You fill the debt. So filling the this fiscal entry is filling the budgetary cavities. That's what the finance commissions do. The 15th Finance Commission capped the interest payment at 7% per year. I mean, if you really look at what they did. But the point is, whether that can be done, what sort of issue will come up. Incentivization is important. Tax effort is important. Fiscal discipline is important. But how are you going to use that is something which is a thing Arvind Panagariya will have to think about. Thank you.
Well, luckily I'm not alone here. All my members of the commission are present here. So that is also for the information of the others, wise people who want to pass on their advice to the commission. We are here in full strength.